Hi, we're talking about Your Money Matters on NDTV Profit because we understand that your money matters. Today, I'd like to talk to you about an investment that housewives and mothers, daughters, women in India have been making over the course of the last several years, and that has proven to be the best investment ever. We're talking about gold because over the course of the last 2 decades at the very least, this is actually something that has beaten equity, it has beaten several other investments hands down. And this is particularly because of the kind of move that you've seen, not just in the recent past, but in spurts over the course of the last 5 years in gold. We're going to talk about why this has occurred, why the price of gold is now at 90,000 rupees per 10 grams in India and over $3,000 per troy ounce in the international market, and where it's heading from now. How should you align your strategy? What's the best way for you to invest? And we'll also talk about, on Wellness Wednesday, which is a part of this program, what nutrition you should follow and how much protein you should keep in your diet. Of course, the reason we talk about this is because we want you to be healthy to enjoy the fruits of your labor and the wealth that you're creating. But the first topic, and that is gold. Why are gold prices heading higher every day? Kishore Narne, Director and Head of Commodity at Motilal Oswal Financial Services, joining me on the program today. Kishore, thanks so much for taking the time. You're essentially setting the context for us because we will soon be talking about how investors should buy gold. But over $3,000 per troy ounce and over 90,000 rupees or thereabouts per 10 grams in India, why are prices going so high?
Yeah, I think, see, gold is something which is traditionally seen as store of value, right? So, and the perception of store of value has not changed. Despite the centuries being passed, the gold has never lost its ability to store value. Nobody was able to shake the confidence of the investors in gold. That's the primary thing about the gold. So that's unbreakable. Because all the other asset classes, including the fiat currencies, at some point of time has this question that whether this asset class still has an upside or not, whether it is too much valued or kind of valuation is something like this. Even in fiat currencies, I'm saying. If we go back a little bit behind, so in 2009, just after Lehman crisis, when the major financial crisis of the millennia has striken us, gold for the first time has crossed $1,000 mark. After that, in 2020, again, gold crossed $2,000 mark. So it took around roughly 12 years for gold to cross another 1,000, the next 1,000. And from 2020, today it's hardly 4 years, we have now crossed 3,000 mark. So it's from 12 years to 4 years. The rapid raise is also showing that how the financial system in the world as well as the geopolitics of the world has actually changed drastically over the last 4 or 5 years, especially the post-COVID. Anything which is questioned, any asset class, any country, any economy, actually drives money to safe havens. The safe havens have been traditionally established either Japanese yen for Asians and dollar for global currency and gold for everyone. So for that matter. So there are various reasons. We can go into a half an hour lecture for why gold went up so many things. So there are hundreds of moving parts, but predominantly is that the unchallenged confidence in gold as a store of value has made it an all-time favorite. Whenever any crisis hits, gold is the way to go. So that's what. So we are in the current crisis situation that's showing in gold.
Yeah, and geopolitics, as you mentioned, there is the crisis in West Asia. There is the European war that has been raging for some time, and you have uncertainties about Trump tariffs and everything else. You have central banks that have been buying gold. All of the factors, as you mentioned, several factors that are contributing to this. The question is, where do we head from here, Kishore? I remember we were talking sometime last year and you were saying that 3,000 is on the cards. I didn't believe you, but that has actually come to pass. And if I'm not mistaken, it was less than 6 months back. But
Yes.
now that we've hit that mark, where do we go from here?
Yeah. So whenever I look at a commodity or any asset class for that matter, the price has grown so much. That's why it is overvalued or it should correct is not a general logic which any analyst will apply to anything. So today, do I have any reason to believe that the gold prices, the rally in gold has ended and it will turn around and go down? So generally, whenever gold corrects, it generally corrects by 25-30%. So have we reached the situation? I think that's the question. I don't see any reason where I can say the end of rally of gold. Number one. Number two, how far we go, because currently we are in an uncharted territory in gold price. At the same time, uncharted territory in the global geopolitics as an environment. And the first time in maybe a century or maybe a couple of centuries, especially in this century, the first time the global geopolitics is challenging the leadership of global economy, whether the US and China war or the trade war or you can say Cold War or whatever you could term it, is challenging the official position of US. So are we? So there are a lot of uncertain things which are going on. So if I look at price, anything close to 3200, 3250, I think we should see some resistance, some kind of profit taking will come. Even today, as we head into the conclusion of Fed meeting today, if the Fed comes out and say that the inflation is going to be much bigger threat and we may look at rising rates maybe sometime soon, maybe a couple of rising of rates might happen, that will bring down gold for a momentarily. But until unless we solve the current issues, I don't think the gold will turn around. So 3200, 3250 short term, anything 3400 could be possible. Again, I'm saying it's uncharted territory. You never know. But there is no reason for me to believe there is an end of the rally in gold.
Okay, last takeaway then, to give our viewers some sense of what their strategy should be. Generally, the advice that financial advisors give is to have a portion of your portfolio in gold. Are you advising your clients even now to go out and buy gold?
Yes, we traditionally advise as part of our asset allocation strategy anywhere between 5 to 15%, depending on your risk, depending on your age, etc., all the various parameters. So generally, commodities should be up to 15% of your portfolio. Again, commodities should also contain other commodities other than gold also. So at this point of time, our view in commodities especially is the best commodity to be in right now, as far as momentum is concerned, is silver is going to go up by another 25-30%. That's we're pretty sure. So that's going to give you a great return. So if you're an investor, long-term investor, you can go and buy silver ETF. Second is probably the industrial metals or non-ferrous metals are also looking great, as we expect the China to recover much faster in the second half of 2025. Non-ferrous metals are going to be a big contender for a good rally in commodities. Gold, as I said, another 8 to 10% upside is there, but gold will give you more stability than returns. So that's an insurance policy which you're going to buy on your portfolio.
Okay. Kishore, thanks so much for laying the context for the next chat as well, and thanks so much for telling us why gold prices have risen and what the prospects are for gold and silver, in fact, going forward.
Absolutely. Pleasure joining you. Thank you.
All right, so now you have a sense of why gold prices have risen to this point and where they're likely headed. And also, Kishore told you to watch out for silver and maybe consider putting that into your portfolio. But I want to know about what Vishal Dhawan, founder and chief executive officer of Plan Ahead Wealth, thinks about this. Vishal, thanks so much, first of all, for joining me on this program. And there are several use cases for having gold in your portfolio. This is a standard that a lot of people have said, put 10% of your portfolio into gold. And there's a reason behind that. The reasons are for everybody to see. But how do you invest in this? SGB is no longer an option. They're not issuing it anymore. How do you invest in it?
So thanks for having me over, Alex. So I think there are multiple ways that you can look at in the absence of SGBs. One is look at the alternative of using um, gold exchange traded funds, which are essentially gold units which are listed on the stock exchange. And one ETF unit is equal to 1 gram of gold. So one of the ways that you can participate in the absence of an SGB is to use gold ETFs. The second way to do it is to buy what are called gold funds, which use gold ETFs as the underlying asset, and you invest from there into the gold instrument, because the gold mutual fund in turn buys the gold ETF. The third way to do it is to get physical gold, which again is an option, because what ends up happening with physical gold is that you have it's been traditionally the way people have bought gold, stored it. They've sort of worried a little bit about the purity of that gold, the security of that gold, but that's always been a way to buy gold as well. And last but not the least, there are what are called gold mutual funds, which buy equities of gold mining companies. So even in the absence of SGBs, there are many other ways to buy gold as an investor, depending on how one wishes to participate in gold.
Okay. Having said that, SGB or sovereign gold bonds are also available in the secondary market. Is there a use case to buying them? As I understand it, they're also being sold at a premium, right?
Yes, so they are being sold at a premium. And what we need to remember is that the challenge with buying it in the secondary market is very often you will not have enough benefit of time available with you before they come up for maturity. And one of the things that you want to be mindful of whenever you have an asset class that has done very well in the recent past, like gold has done, is that you might want to be careful about how much you put in at a particular point in time. Because what we've seen happen is that if you look at gold prices adjusted for inflation since a long period of time, they seem to be more expensive than where they should be. So there's obviously a reason for that. There are geopolitical risks, there are tariff concerns, there are China buying that's happening, etc., which is happening. But if you just look at fundamental factors around gold in terms of it being a good hedge against inflation, you will find that gold seems to be a little overpriced as an asset. And because of that, you want to go in gradually rather than go in with large chunks of money at this particular point. And maybe SGBs are not the best way. The other thing you want to keep in mind is the liquidity on SGBs is actually very low. So if you go out in the secondary market and start to look for SGBs to buy, you might find that you will not be able to buy it very easily. And you could end up spending a few days just being able to, just finding the SGB that you want to be able to buy. So it's not something that's very commonly and easily available for investors to participate.
Okay. We've been speaking so far about buying, but usually, Vishal, the standard thing to do when there is a change, a dramatic change in your portfolio, and here I'm talking about individuals that may have gone out maybe 5 years back and subscribed to an SGB, as a result of which the value of the gold in their portfolio has risen very dramatically, and the notional value at this juncture will be significantly higher than what they had when they invested. And so would you say that it might be a good idea even now to go and sell it in the secondary market, or even if it comes up for redemption, don't wait for the entire 8 years, you can redeem it after 5 years, because like you said, it's on a red hot ride, maybe it can see some price correction.
So it is an option. I think one needs to think about it very carefully from a portfolio perspective. And if you have gone over 10% exposure to gold in your portfolio, you might want to think about using some of these premature redemption windows that RBI offers every 6 months to give up some of that SGB that you have in your portfolio. There is an advantage that you end up getting sometimes when you do that as well, because the taxation on the SGB, when you give it back to the RBI, is more favorable than if you sold it in the secondary market. So there is a tax reason why you might want to use it through the redemption window as well, rather than trying to sell it in the secondary market. But do this only if you don't have 10% exposure. If you've got more than 10% exposure. If you don't have 10% exposure, then I think it's fine from a portfolio allocation perspective to continue to hold that gold to maturity.
Okay. Should people go out and venture out and buy gold at this juncture, in your opinion, if they don't have any exposure to gold, considering that we're at, 90,000 per 10 grams at this juncture?
Yes, and therefore you'd want to do it through an SIP sort of route so that you're buying gradually. You do run the risk when everyone is very bullish on a particular asset class, that might actually be not the best time to participate. And clearly, because it's done so well, if you look at the trailing returns on gold versus the rolling returns on gold, which means you remove the base year biases, you will find that the trailing returns look abnormally high as compared to the rolling returns. And therefore, it is a very good idea to be gradual in terms of adding that exposure to gold if you don't have it already, rather than trying to buy big chunks of money in gold with the fear of feeling left out. And obviously, there is lots of news coming in about how gold can continue to go up, and there is a feeling of missing out that can obviously come in that kind of scenario.
Okay, last question, and this has to do with silver, because Kishore, who's a specialist in commodities, says that silver is the place to be now. The potential upside is significant. If you do want to take exposure, first of all, would you do it within that limit that you've set for 10 to 15% of your portfolio? And how would you go about doing it?
So it's, if you look at gold versus silver, clearly the gold-silver ratios seem to indicate that either silver is very undervalued at this point or gold is very overvalued. And therefore, either gold has to correct sharply or silver has to go back to normal ratios. So clearly silver does look like a relatively better asset as far as investing in commodities today is concerned. The second thing that's happening is that if you again look at inflation-adjusted returns, silver is well below an inflation-adjusted return over long periods of time, unlike gold, which is well above. So again, there is a little bit of a case that is built up from a fundamental perspective on why silver might be a good option, on top of the fact that there are industrial uses which are far beyond just the safety use that comes with gold. So I think silver is an option. The way that we think about it is that you should have probably anywhere between 3 to 5% of exposure to silver and the balance 10% to gold as a part of your overall portfolio. And once again, when you're buying into this asset as well, ideally try to build it up gradually rather than trying to go in large lump sums. Again, because the recent returns of silver have been abnormally higher than their rolling returns. And therefore, you don't want to end up in a situation where you just buy at the wrong time of the cycle because you felt that you were going to miss out and therefore put in too much allocation to silver in one shot.
And silver ETFs are the best way? Silver ETFs are the best way?
Yeah, use ETFs. And if you feel that you want to give the flexibility to a manager to decide between gold and silver, there are now also gold and silver fund combinations that are available where managers can decide on how to mix it up. And you don't have to do that. And that's obviously very efficient for you from a tax perspective, because the rebalancing costs between gold and silver is not something that you need to worry about.
Fascinating. Vishal, thanks so much for joining in for this absolutely important conversation at this juncture.
Pleasure.
All right, so we've given you a sense of both gold and silver, precious metals. By the way, silver, very important point that Vishal was mentioning. The pushes and pulls with regard to silver prices are not just from the perspective of precious metal, it's also used in industrial applications. So bear that in mind as well.